Welcome to our fourth quarter review at Greenleaf here. We wrapped up this quarter. It was very exciting overall. We look at our reports that are coming out. We have all of our distributions. Critical date is the 20th of the month. That's when all our distributions go out. All of our property-specific details and our property reports are also in our investor portals to go through. And if you're in any of our debt funds or if you're in the new Greenleaf Income Fund, those distributions go out on the 10th of the month. Even at the end of the year, they always go out 10th of the month. So let's dive into things. We're going to first go over just what we're seeing in the real estate market as a whole and how things went for the fourth quarter.
2025 was a better year than 2024 as a market. It was up about 20%. But compared to 2022, when we really did our most volume and the market did its most volume, we're still down about 40%. We ended up doing 2 commercial deals and a handful of retail deals, but really the biggest volume was our debt deals. We had about 6 of those, and then we launched our income fund as well. What we're finding in the market is that the key to getting deals done is really relationships. The 2 big commercial deals that we did, which was Friars Crossing and the Hiram Flex property, that we call Westside Flex, they were both done not because they were publicly marketed, not because a broker had a pocket listing. It was because we had key friends that knew the owners of the property that were able to connect us and make a deal happen after that property couldn't sell. So we're still seeing deals take a very long time to close. A lot of buyers kind of come and go, and we can be in the right position to buy, and that's what we did, and we struck while the iron was hot and bought these 2 commercial deals.
And we've consistently been a second or third place finisher in most deal offerings. That's really where we've lived the whole time at Greenleaf, right? And those are deals that they came back around, basically. We were able to close on them.
Yeah, I mean, the Westside Flex deal, I think we heard it kind of whispered by brokers around $10, $12, $11 million on and off. And eventually it just kind of, the brokers kind of gave up and kind of fell apart. And they like, hey, where are you guys at? Just let us know what you can do. We just got to get this thing closed.
Yeah, that's our sweet spot for buying deals, is that. But that's a longer relationship-driven process.
Right.
Yeah. On the operating front, one of the key things we saw in the fourth quarter was a really operating efficiency. We have been kind of pounding the table that like taxes and insurance continue to go up. This quarter, we actually saw taxes decrease in many different asset classes, and we saw property insurance rates either be able to get better coverage that we needed or overall insurance rates coming down. So that was very positive, but we still have to be extremely diligent on just operating efficiency. That's a big number that we are tracking and looking at monthly, quarterly on how we're doing. So everything we can do to make things more efficient on the operating front. A big push right now has been software, a lot of software costs. That's kind of the next thing that we've seen lots of price increases in, and that's one of the things that we're trying to tackle and reduce our costs on that. Software is real estate in general is heavily reliant on software to operate. So we're working on that front, but then always maintenance and repairs and being able to do stuff preventatively versus reactively is really what enables you to have a strong quarter on a deal or have that quarter kind of fall apart on paper if costs get out of whack. So that's a big part of what we saw in the fourth quarter. And that's going to be a running theme throughout 2026 as we look at how do we keep deals to perform consistently in the long term.
Our commercial deals that we've owned for a while now, like a Johnson Square or some of these other office or flex properties, as investors know, we reserve money every month, every quarter, and we have these very healthy balance sheets. So as long as we stay ahead of that, as long as we have we build software products that help us to basically monitor the HVAC life cycle, the hot water life cycle, the plumbing life cycle, et cetera, et cetera. We can use those reserves and kind of have a smooth distribution process as we stabilize these deals.
Fourth quarter for me, it's about, first of all, transaction volume was definitely improving, but not where it was. And so we're still kind of figuring out like where things are priced. And so products or properties that would have sold in a month based on a cap rate 2 or 3 years ago, they're taking a long time to sell right now. So we have some that we're trying to sell, but we're not willing to go down. And so we're doing the same thing the market's doing right now, is that we're trying to test. We're going through a price discovery. And so the deals we're buying at the highest cap rates we've bought probably in 5 or 10 years. But then when we're trying to sell, we're also going to be products of that price discovery too. Interest rates, of course, aren't helping. I guess a lot of buyers have left the market, unfortunately. And so when there's it's a whole supply game. And so if there's more buyers, or more sellers than buyers. I mean, you know what happens. The prices change, and that's what's happening right now. And for me, uh, 2000, the end of 2025 was really about, prices starting to finally. There was the light bulb, I think, lit above everybody's head and say, oh, okay, I guess prices really have changed, and prices did change. So.
Yeah, I mean,
That's
your
what it
point
was
on
for me.
price discovery, I think, is really relevant because on a daily basis, we're getting 20 or 30 email blasts from brokers and seeing, call it 6 to 6.5 cap rate listings, and those aren't being realized. So a lot of these deals aren't actually selling, and a lot of these sellers are, I would say, unrealistic to today's market. So I think everyone's just trying to play this tug of war game of like, where's the actual deal going to trade at? And some are trading better than others, and some are trading worse than others, but. We're still playing a little bit of tug of war, but with these new interest rates.
Right, and don't forget, like when you could sell a 6 or 6.5 cap deal 4 years ago and get 3.5% debt, and you'd make some money. If you're buying a 6.5 cap deal right now and getting a 6% rate on debt, you can't make any money. And so what that means is, the only people buying these lower cap rate deals or cap rates lower than interest rates are cash buyers. And if there's this much of a pool of buyers buying with debt, there's this much of a pool buying with cash. And so, again, the buyer pool is just shrinking for those lower cap rate deals. And so everybody's looking for a deal. And so, us too. I mean, so we're taking advantage of the market. I would say we're definitely buying at aggressive cap rates, but then only for certain products, because I think for industrial or other products, the cap rates are not getting aggressive yet.
Yeah, they're not there to buy at high cap rates.
Yeah.
We've some of the retail stuff we've bought at cap rates in the 9s.
Yeah.
That's not they just don't exist right now to purchase.
So an apartment complex with an existing 9 cap in place right now, I guess, doesn't exist either.
No. Yeah, so that stuff's in the in the 6s or the 7s for the asset types that we purchase.
And what's your last? Do you remember what's Fannie and Freddie quoting right now on apartment loans?
I think mid to high 5s.
Mid to high 5s.
Yeah.
But then they're still going to trade at like a functional apartment complex. They're still going to trade at like a 5 or 6 cap rate.
Yeah, I mean, we're looking at the apartment deals that we exited in 25, and in the fourth quarter, we're selling in at 6 cap ranges on those deals. So that's not something we couldn't buy at a 6 cap on the residential.
Yeah, I mean, there's
side.
got to be a value add component for that too, because when your debt's 5.5 and you're buying it at in place 6, I mean, you have to have a value add component. If you don't, I mean, it's just you're toast.
The true value add has been a little tricky to find. There's not a whole lot of true value add. Like when we think value add, we think like this property is a disaster and we have to go do something. Not, we're gonna, refresh the side of this and it's gonna be nicer. It's
Put
like
stainless steel appliances in. Yeah.
No, it's gonna be a disaster, and then we're gonna totally fix it up. But there's not a lot of disaster retail. There's not a lot of disaster apartments. There's not a lot of disaster flex.
Yeah, I mean, the leasing market that we've seen has been incredibly aggressive and strong. And so when we're looking at deals, the value add is like, hey, there's a bunch of tenants in here and they're paying $10 a square foot. And by the way, the market's now 14. You can buy this thing and over the next 5 years, all the leases will turn over and you get to 14. It's like, oh man, it's a long time.
Yeah. One of the deals kind of like that value approach, like one of the deals we did about 3 years ago, the rents were like $1 a square foot.
Right.
It's like, and it's quasi-ish tenants, like that's a disaster.
Yeah.
That's worth trying to fix, and there's big value add opportunities there. Now we're going to look at our specific asset types and go through how those deals are performing and what we're seeing in those segments. Industrial flex. We have been in this space for about 4 years at this time. We've done 14 deals and just a little over 1.2 million square feet of acquisitions during that time. Our business plan here was taking deals that traditionally were not flex. They were office or they were something else, and we were converting them to this industrial flex category. And even industrial flex, if you go into any reporting system, the industrial market is enormous, whereas the flex part is like 5% of that. So it's a small piece of the overall industrial market, and the naming convention is fairly loose. But to us, we're looking at 15 to 20 foot height ceilings, roll-up doors, a few offices in the front, and typically 5 to 10,000 square foot users. That is what we are looking to create. So as I mentioned, we've done 14 of these deals. We look at our momentum in the fourth quarter, And the fourth quarter alone, we saw our occupancy is at 74%. We're trying to buy deals that are 0% occupancy and convert them to flex and then fully lease them up. We want to do that as fast as possible. This quarter alone, our revenue is up 9.2%, and that comes from new leases and lease escalations that are built in. Throughout the year, we signed 175,000 square feet of leases over 28 leases. In the fourth quarter alone, we signed 55,000 square feet of leases on 10 leases. So that comes right to 5,500 square feet on average is the lease that we're getting. Our rental rates we're seeing are in the $9 to $10 range on average, and we're seeing $3 to $4 CAM rental rates. Now, on the low end of that, we have really like a true flex asset roll-up door, not conditioned, 4,000 square feet, that type of a space. We have some of those in Columbia, South Carolina that we've rented for $6 a square foot, plus the $3 in CAM. Whereas Lakeside Flex here in Atlanta, which was a very nice office building, that's single story, we've converted that to flex and we're getting $1,875 plus CAM at that. So our range is fairly wide depending on the quality of the asset that is already in place. That's everything from the location to the entrance and what the complex looks like. But overall, we're still seeing great momentum on the leasing of these flex spaces, and we're excited with the progress we're making. Now, some of these are taking much longer than we would have wanted. We try and target like getting these things done quick as possible is the goal. In a few of our deals, we have larger suites that are just taking a long time to lease.
Yeah, so the length of time really depends on the type of asset we're buying. So we recently bought a film studio, and this was, yes, it was built as an industrial property, but the use of it was to store props to office directors and actors, et cetera, and to film things and to kind of have sound stages kind of come in and out. And there's not a whole lot of physical conversion there, but we are having to take some time and kind of change the marketing of the property and let it be known that this is now an industrial use property. Fortunately, we closed the property late summer. We've already signed one lease for about 10% of the property. We're renting out some of the parking lot as kind of IOS in the meantime. It's going incredibly well. Some of our other properties that are traditionally office, they're zoned office institutional, which by its name is predominantly office use, air-conditioned space that we're having to basically demo out, clear out, put a roll-up door on the back. And as a result of that, we have to have lots of conversations with the city and the surrounding neighbors and really the area to educate them on what we're doing to the property and also to educate them what kind of tenants we're going to bring to the property. So that takes a little bit longer, but we're normally able to buy those at deeper discounts to basically pay for the carry time. So all in all, we like both. We like both styles. It's just a different approach, and sometimes it takes longer than others. Based on that, overall basis, we're really targeting this give or take $100 a square foot to kind of be in it. Sometimes we're in at like 110, 120. Sometimes we're in at 80. But give or take $100 a square foot, and now we're looking at exiting some of these properties that we've completed the business plan. So Kennesaw Flex is really one of the first ones. We're exiting that one at over $150 a square foot. We're also completed the business plan on Pleasantdale and in Davis as well. And we're basically looking at, is this property better to refinance and hold long-term? So we're quoting those, getting debt quotes out with our lenders, as well as marketing those to see what kind of value. And if we can strike a deal north of $150 a square foot, maybe even as high as $160 a square foot, we'd be happy to take that.
Yeah. This goes back to a lot to our apartment strategy. Back in the day, we were doing deep value add deals that were very vacant, needed a lot of work. We turned them around. And then once they're stable, it's like if we could refinance them, if there's a way to hold them and generate cash flow, okay, that would be fantastic. But a lot of times it resulted in we have to sell this to realize those gains and really fully complete the business plan.
Yeah, if you look at our current kind of apartment, in our apartment review, we talked about that we're down under 1,500 units. Those 1,500 units that we have left, we were up close to 5,000 units. So we really only kept about 25% of what we bought as a cash flowing asset. The rest, we really bought them, renovated, leased it up, got it to a stability point, and then looked to exit. So we kind of had the same sense that industrial flex is going to be a very similar strategy for us. And now we're kind of ending that, as Dave said earlier, the end of the fourth year, going into our fifth year on our first round of assets, and we're in the position to basically exit those or refinance.
Yeah, and that sales process, the Kennesaw one will close shortly. The other two, we mentioned Pleasantdale Flex. We just signed a lease there to take the remaining 9,000 square feet. Also on that deal, we had a small back parcel that we weren't really using. It wasn't really accessible from our parking lot, but our neighbor, it was useful for him.
It wasn't flat either, so we
No,
couldn't
it's
even.
side of a
we
cliff,
couldn't,
really.
yeah, we couldn't turn it into like a laydown yard. It was not
Yeah.
very useful for us at all.
So he's able to fill it in, and they paid $200,000 for that small parcel off of ours. So we're able to pay down some debt on that deal as well. So it's in a very good position. We have the longest weighted average lease term we'd have there. So that's one that we are looking to take out and see what we can get.
Pleasantdale is a great example that this was a very traditional industrial flex building, higher ceilings. I think there's 24 clear height there, roll-up doors, truck access, etc. And the biggest challenge with that property was that rents were $3 a square foot when we bought it. So it's been 3 years. So if you held it's been fully occupied, then we basically took it all the way down as leases expired, and now we brought it all the way back up. So, but instead of $3 rents, we're now north of $10 rents on the property, and we have an average rated lease term over 3 years. So it's really in the best position to do something else with it now.
And some of the tenants there, I mean, we had one tenant just had old electronics stacked floor to ceiling, whole thing. So some of these are a lengthy process to turn those units over, but we're there now. We've completed that business case. So we have 3 deals that we've completed the business case on of 14 that we're looking to realize the gains in. The Davis Circle deal is one where we had 2 tenants and we consolidated that and built out essentially one large headquarters for the tenant that's there, which is a dog food manufacturing company. So that's a great lease that we have. They're a very good tenant, and we're going through the process to see what kind of offers we can get on that deal as well.
So if we look at kind of the next round of properties that are going to make their way into kind of the stabilization period, we kind of have twofold of what's going on. So we're sitting here at Forum Flex today having this discussion. We have Lakeside. These are properties that were bought with really, really low occupancy, needed some renovation, and we increase the occupancy. And we're really close to doing that, and it should happen in the really next 6 to 9 months. But then you have properties like Top Notch or Covington that we bought fully occupied at really low rents, $6, $7, $8 or so.
I mean, Top Notch was the lowest rents of any place that we had purchased. And that whole strategy there was, I mean, they have a lease, so you can't just kick them out. They have a lease. We don't really do buyouts where we're going to try and buy them out early. That's not something we're doing. So as those people vacate, then we're like, okay, hey, we got to go in, and we're really, almost doubling the rents that are there when we sign new leases. And we can't sign below, we can't do really low leases there. We want to get the rental rates up there. That's we're going to realize that deal. And that's taken us longer than anticipated at that deal.
And that was one that we bought, and right away we had some, I would say it was basically fully occupied, and we were able to make some distributions. And now we're kind of in the lull of the deal that, okay, we've gotten a lot of these lower paying tenants out, and now we just need a little bit of time to ramp up. So we made some distributions early on in this deal. We kind of hit the pause button saying, okay, we're at kind of a low occupancy level. Let's ramp back up, and then we'll continue distributions there. But we're just kind of in the depths of that.
Other properties that we have the larger vacancies at, places like the Forum, where we have 2 15,000 square foot suites. We have a lease in the works that's in theory is starting February 1st on a chunk of that space. Working on that one. And then we have Lakeside. There's a 20,000 square foot and a 16,000 spot there where we had a very large tenant that had almost 60,000 square feet. As they downsize and leave, and we replace that with more kind of our size tenants, that business plan will come to completion. And then the ones that are just the super vacants, like the Hub, where we're really turning the whole property, working on it. And then West Side Flex, where vacant, and we're leasing up 80,000 square feet. So a lot of our vacancy when we come in and say, oh, we're in the 70% occupied, is because we have these vacant spots that we need to finish to complete those business plans. And some of them are brand new. We just bought West Side Flex. Yeah,
and then I would say one of the exceptions to everything we're explaining right now is Friars Flex. We bought that really late last year, and it was I would say it was kind of a disallocation in the market that Chattanooga not as kind of publicly seen on kind of a national stage like in Atlanta. So there weren't as many buyers. We own a lot in Chattanooga, and we were able to get the property really discounted to make a great purchase that at $100 a square foot, fully occupied, or it was 91% occupied, get the existing tenants by having good conversations with them, making friends with them to expand, take up the whole space. And basically we have distributions right out the gate.
Yeah,
so
exactly. So right now we have about 270,000 square feet that is vacant. If we continue our trend of leasing around 50 to 60,000 square feet per quarter, now that's our target that we're working at here. We'll lease mostly all of our space in 2026 of existing opportunities out there. So that's really our focus going to 26 is completing these business plans. If we optimistically, we're going to have like 4 more deals that complete that business plan and are fully occupied with the longest lease. And at that point, we're going to look to, take that to market and see what we can do on those positions as well. Those probably won't sell in 26. We have our other 2 that we're talking about, Davis and Pleasantdale, that are kind of first in the gates going through that wave. But the rest of them, that's going to be where our plan. In all of our investment overviews for each deal, we have the specifics of really what the exact occupancy and leasing traction is on those deals, and that'll give you a good idea of where we look deal specific. Next part we're going to look at is our debt opportunities. And these really started a few years ago as we were talking with other operators and ourselves, going through the process of obtaining new debt. Interest rates were rising, our amortization periods, because we're always doing principal payment loans, and then just the bank fees associated with getting the loan was pushing our all-in debt cost over 11 to 12%. So that was too high for the deal. We're like, there's got to be a better solution. And we looked at it as saying we could easily pay over 8% and just use cash instead of that debt. So we've done a couple debt deals now where we are the lender. Those deals are paying on a monthly basis. Distributions go out every 10th of the month. We've done almost a dozen of these kind of deals at this point. And if you're in one of them, you're getting consistent distributions on the 10th of the month. We took that platform and we've now expanded that to launching our first income fund. And the goal of that was we found lots of opportunities for low leverage, good position debt, but sometimes the amounts were only a couple $100,000 here or there. That's a hard amount to syndicate in one offering. And then if investors come into that, now you have, a bunch of smaller investments where you're getting a lot of different K1s in different states. So we said, okay, we're going to put this into an income fund and we're going to distribute it as a dividend. So it's very simple. It's just a 1099 and it's consistent distributions on the 10th of the month. So that income fund is really what we launched going into December of 2025 in the 4th quarter. And we've done 2 deals in that format as well. Now, our overall debt positions, that's something we want to review of just where they are and how they have been performing.
So the biggest opportunity in the income fund was really taking deals that we were either attracted to, that we wanted to invest in, or that we already owned and had a long track record with and had a good knowledge of. And so we started with doing a couple deals in Texas with a developer named Epitome. Dharma's the owner of that company. We've done 5 deals with them. And we've done about 5 other deals with Greenleaf deals that we've had a lot of track record and history with. And as we look forward with the income fund, then really the future pipeline, the next 4 or 5 deals is really looking at Greenleaf deals and saying, hey, opportunistically, instead of paying the bank 1 point, instead of paying the bank 6 to 7% interest rate, instead of paying the bank on a 20-year amortization, why can't we just pay ourselves 8 to 10% in our income fund and be in a better position? Again, that 1 point that we pay on the front end every time we do or renew the loan with the bank, if you amortize that over a 2 or 3 year loan, that's real interest that gets counted in as part of the fees. So the biggest opportunity here that we're able to create internally is the banks have to have this very convoluted underwriting and diligence process to report up. Our underwriting and diligence process is, we've owned this deal for 5 years. The loan has now been paid down under 50%. We've been consistent payers. Why don't we internalize this loan?
One of the ones we did in the 4th quarter here was one of our mobile home parks where we had a loan. And we had a loan on a portfolio of mobile home parks, and this loan amount was only $285,000. So it was a very small loan. Redoing one of those loans with the bank isn't super interesting for them. It's small overall. It was only a piece of a larger portfolio of it, and we were going to have to pay a lot of fees to redo this one. So we're like, okay, hey, we can just do this one internally. We did that with the income fund, and now the income fund is receiving that note payment, it's essentially the same payment that the property was making before, except it doesn't have all the fees associated with it. So it's better for the deal and better for the income fund.
Yeah, along with the same lines, we have an apartment complex in Atlanta that the loan is under $1 million. Well, apartments have appreciated so much that new lenders don't want to look at apartment loans under $1 million anymore. So they looked at us and say, hey, we'll work with you, but we want you to lever up this asset more. And in general, especially for longer term assets, we're not looking to lever them up. We're looking to operate them for cash flow. So we would rather just pay off that loan with the income fund and keep the cash flow going to our investors.
Yeah. We do expect to see a good amount of debt opportunities throughout 2026. The market conditions, interest rates are still relatively high. The 10-year and some of the interest, I mean, they've dropped a little bit, but overall, interest rates are still relatively high. You still have amortization associated with it, and the fees and requirements of the bank lending process continue really to grow. We look at that from the requirements that the banks place on borrowers. So a lot of times, if we get an option for a loan, it comes with, we either have to put in some pretty significant just cash deposits at the bank that we can't use, or will be locked up and tied up. We've had that on some of our commercial deals, like our TBTC deal, where we have a huge amount of reserves locked at a bank that they don't pay interest on and we cannot use. We're trying to avoid situations like that. We do not want to be in that position.
Well, you use the word huge. Like, this isn't tens of thousands of dollars. This isn't $100,000. Like TVDC, we have 7 figures parked to this bank, and it accumulates every month to grow. And we're not getting any interest on that. And we're kind of locked into this loan because of the structure of the loan.
Yeah, we have over $1 million in reserves there that earn no interest and we can't use. So we want to avoid those kind of situations. And that's a lot of the lending environment that's out there right now. So we feel that this product is more competitive. And again, some of the other conversations we've had, we're really only doing this with relationships we have. This isn't a business where we go out and just marketing on billboards for, who wants to take out a loan. That's not how we operate here at Greenleaf. So these are all entities that are well known to us and then we have a working relationship with before we do anything. So that helps us on the front of understanding exactly what's happening in a deal.
Yeah, and 90+% of what we're looking at are real estate loans. Occasionally we will look at a business loan. So we have one of our tenants that came to us and was looking for an opportunity, and they asked for a loan that was 5% of their annual revenue. Like, that's somewhat of a no-brainer that, they're willing to basically put their business on the line for this relatively small loan and relatively short-term loan to expand a part of their product line, that it was just easier to work with us than going to a bank.
Yeah. So we're excited about that. And all those flow into our income fund, making the monthly distributions for it. So our biggest shift in the debt side is really launching the income side, the income fund, where we're now kind of packaging the smaller opportunities that we do find together and making it a lot easier on the investor reporting side, where investors only have one 1099. They're not receiving a K1. So it's a different structure, but it's a lot more streamlined and easy to work through. We do plan to see a lot of opportunities coming up in 2026 on the debt side, and we'll continue to send those out as we have those in hand. We definitely expect that we're still going to be seeing 8 to 10% plus cash on cash returns out of these type of opportunities throughout the rest of the year as well. So those are very much our current income focused investments. There's not a huge value add proposition to that. Most of these are you're receiving that current cash today. Overall, debt for us has been a very positive performing asset. We're excited about the opportunities that are in it, and we're excited about how well it has performed and continually making the monthly distributions on the 10th of the month. So that wraps up our debt conversation for the fourth quarter of 25.
In the retail business, our simple model is it's as simple as it gets. You buy something on a shorter lease, and you sell it on a longer lease, and the longer lease will always be worth the most money. The best thing we could always do at Greenleaf is the day after the lease is signed for the extended lease, that's going to be the highest value of the property, and that's when we list it for sale. And so we've continued to do that in 2025. So in 2025, we sold 2 deals. We sold our Applebee's Seneca, and then we rolled some of the 1031 proceeds into one of our purchases. And we also sold our DQ property, which is the last of the 2 properties in our original Original Fund One.
Original
So
Fund
that was
One.
the first thing I did when I got here. The Triple Net Fund One, and so we realized a nice gain on the sale of DQ, and we paid off 100% of everyone's equity they've invested in Fund One, returned a little bit of capital, and to make things even nicer, essentially we still own the Zaxby's that we have in Original Fund One with no equity in it. So essentially all of the profits from the Fund One retail has paid off all the equity, and so right now the Zaxby's is essentially free and clear. Other than, I mean, we do have debt, but there's no equity left in that one. So that was the success for 2025. And then for acquisitions for 2025, we closed out our bundle too. We also closed out our sale at DG Sylvania in April, and in May we closed Dollar General Eton, and Dollar General Eton was a 1031 from our Applebee Seneca sale, and this was a bit of a unicorn too because it's a 20,000 square foot DG Market, which is it's in kind of a different footprint than a Dollar General. Dollar Generals are usually around that 10,000 square feet, but this is essentially a 20,000 square foot grocery store. It's kind of a unicorn, does very well. Foot traffic from Placer, it's one of the top performing DG Markets, and if you put the Dollar Generals in there, it's even top performing against Dollar General and Dollar General Markets, and so it's a great place. Dave and I went out there when we bought it, and we had a lot of fun with some drone pictures and learning about the market. But it was also very close to the carpet capital of Georgia, Dalton.
Yes, right outside of Dalton, Georgia.
Yeah, and so that was kind of fun.
So we've talked a lot about Dollar Generals. I mean, we've been really bullish on Dollar Generals for several years now, and one thing that happened really early last year was that the stock really it really just dropped in half. It went from about $150 a share down to really the high 60s a share, and between tariffs, between kind of overbuilding, they said they were going to basically close 10% of their stores, and some leadership changes. Or in a year time period, it basically went down. It took that news, the stock took a dip. Cap rates went from, call it mid sixes to high eights. We cherry picked a handful of deals. We're still cherry picking deals, and now the stock is completely recovered. So anyone that really bought that dip, you bought in, give or take $70 a share. It is now trading for $153 a share.
And you bought a little bit of stock along the way, I believe,
did.
And so did I.
Yeah, big believer.
Yeah, you're a big believer. And but you were I sold, made some money.
Yeah, I'm still holding on.
You're still holding. Yeah. You doubled your money. So good job, Josh.
Exactly.
Good Josh. You win.
In that position, we saw the opportunity when we see things that are not performing well in the market. We typically see a corresponding higher cap rate on the retail front. So specifically the Dollar Generals, as that news came out and the stock price declined, the transaction volume of Dollar Generals in the market, since there's a lot of them, there's 20,000 of them, the cap rates started to rise. So now they went up as high as 8.5. We have some that are under contract right now that are buying for 9.2, 9.4% cap rates. As the stock has recovered and the news is more positive with it, we expect to see those cap rates then trend back the other direction, because the cap rates in retail, yes, there's lots of fundamentals that go behind them, but there's also that component of the emotional, like how is this doing versus how is this not doing, because a lot of retail is still owned by individuals. I mean, there's big funds out there and all that stuff, but there's a lot of retail that's just owned by individuals, and there's that emotional decision on when you're going to buy something or when you're going to sell it based on what's in the news. So with Dollar General specifically, we've seen 9+% cap rates, which is a spot we can't buy in any other asset class anywhere that's in place and operating, consistently performing, with great placer data and solid payment history.
Back to, people are making decisions based on emotion and stock price. But to me right now, because the stock price is going up and Dollar General is improving their business model, I think there's going to be the cap rates are going to start to dip down too. And we saw this last year where the cap rates went up, and then there was good news and the cap rates went down, then there was another dip up. But I mean, I think ultimately right now, 2026, for me, my prediction is Dollar General cap rates will continue the progression either down or stabilizing in that 6 sort of range that they used to be in.
And I think part of what the three of us love about Dollar General is we got started in real estate with needs-based housing. So really, the type of housing that all of us bought and got started in our business was in multifamily. Was there wasn't really a lower cost way to live, and we could provide people the opportunity to live in these places, for a reasonable rate. Dollar General is really needs-based shopping, so there's really no other retailer in the markets that we're buying in. There's really no other grocer like the Eton that is the grocery store for Eton, Georgia. So we like the position with the lack of competition that Dollar General has in most of its places. And it's been a well-performing, well-operated business over the years. The other part, the Dollar Generals that we're looking at, and I think this kind of leads into our next topic in retail, is that we're looking at buildings that have low rent, meaning that the rent's replaceable. So if for some reason that Dollar General decides to close that store, we have a low enough basis and low enough rent in there that we can get another tenant to come in. So that kind of leads to the Family Dollar conversation.
Family Dollar was a great piece of real estate in a great location, and it was the right business for that area too. Private equity, the company that bought it, made the decision to actually close it, which surprised all of us. And their decisions to close it aren't necessarily decisions that maybe Dollar General would make, because Dollar General would actually try to possibly improve it, but ultimately private equity is just trying to buy this for $1 billion and sell it for $2 or $3 billion in 5
Well,
or
they
5
came out and
years.
said they're going to close a huge portion of the store.
Yeah.
They got to resize or right-size the business for it to operate effectively. So Family Dollar is seeing a bunch of stores across the country that are going to be closed and liquidated in this transaction. And sadly, our Family Dollar is one of the ones that's closing. However, when we are looking to buy retail, we're trying to buy stuff where we see good locations, we see cheaper rents, and we see placer data that shows that people are there.
Right.
So this one, when we say it's to the right of the bell curve, that means our placer data and our foot traffic shows that this is a more popular location than many of the others. And, we want to see the upper 30% of range. So here, with Family Dollar leaving, we're now going into that process of, our business model of buying a shorter term lease and extending it. If we don't get an extension where the tenant leaves, it's then now we're going to replace the tenant.
And this is a very, our rent in this building is about $12 or $13 a square foot. So very replaceable, great area. Lots of interest in this property. Of all the listings we have right now, there's a lot of interest on this one. The big question is what's going to be there. And there's a little bit of some restrictions on this place. So that when we first listed it, every single, more than half of the phone calls I received were about putting liquor stores there. Unfortunately, liquor stores are not permitted in that location due to an I-20 overlay district. And so we're looking at a lot of other options right now. We've looked at, of course, the single tenant option would be the best. We're looking to lease it or sell it. One of the other options too is to actually split it into a multi-tenant, possibly a 2-tenant location, or 3-tenant. We could have 2 tenants in the front and then a 1 tenant and more of a warehouse in the back. But so we're going to possibly look at splitting it up into multiple tenants or just lease it to somebody else. Bottom line is we'll be able to do something with it. The question is, what does the use look like?
It's going to be a mix of how are we going to get the best and highest paying tenant into the space going forwards as efficiently as possible.
Correct. Or the highest and best sale too, just depending on which
it could be.
we take.
A lot of the big transactions right now we've seen are owner operators, and that's kind of in any asset class. That's what really people are holding out for is, can we sell to an owner operator that's going to be there? Typically the transaction prices are a little bit higher, but really that's what everyone out there is trying to sell to right now. That's what consistent message we receive. So that is an option, although we're not saying we're not going to put all our eggs in one basket for one plan. It's like, what are we going to come up with the best way to get this re-tenanted? And we are looking at negotiations with different single tenant users right now. And just like in our flex space at 10,000 square feet, if we divided it to 3,000 square foot suites, we would see faster lease momentum. So we're going to put that out there as well, see what we can get.
And so for 2026, we're continuing to buy. We're going to, we've got 2, our Dollar General Bundle 2. We're going to close on in a few weeks, and that'll consist of Dollar General in Angelico, Tennessee, and the second one will be in Dollar General, Elizabeth City, North Carolina, and that'll close out our Bundle 2. So we've done 2 bundles for Dollar Generals, and these are cap rates, and the blended cap rate for these 2 is 9.2%. So we have not seen that in a long time.
It's exciting.
Yeah. And also, we're about to, actually, we just signed a PSA for this one, but we're selling our Panera too. So our Aiken, South Carolina, Panera is under PSA to sell, and that's what's happening with retail right now.
Yeah, we're still very bullish on buying retail assets. They've continued to perform well. We've seen steady, not only rent growth, but rent payment. There's not like a lot of delinquency in the retail space. So it's been a very strong performer for us and consistently making our quarterly distributions. So we really like that about the retail side, and we're going to look to acquire more in the coming months. The next segment we're going to go through is our commercial assets. And our definition of commercial is really medical tenants and our government lease tenants. And a lot of our government stuff is predominantly the VA clinics. So it's a mix of government medical services together. But medical and that government segment make up the majority of our tenants in the commercial space. The other side of that is really garden walk-up style small office suites. And that's kind of the other chunk of what fits into our definition of the commercial. Deals that represent that kind of segment are deals like the Station or Crossing Center, where these are 2-story, well-located deals that in the long run are occupied with significantly smaller 1 to 3,000 square foot tenants. Now, as a whole, in the fourth quarter, we did see positive leasing momentum. We leased 32,000 square feet across 14 tenants. So these are all small move-ins that are occurring. We saw our overall revenues go up 4.5%. Again, all of our commercial tenants do have CAM, and we'll be reassessing that as we get into 2026 for 2025. So the first quarter of 2026 is we see those new CAM rates that do hit. So we had 4.5% revenue growth from a bunch of new leases that we did sign. However, we had one big tenant that left, kind of ate away all of our gains when we had our Duke Medical Building, where Duke actually left, and we are working on replacing that tenant. We do have one 8 and one 10,000 square foot user that we're going back and forth with there to see who will sign and take a portion of that space. So we're excited about that. But it's like we made a bunch of positive momentum in one big lease that makes it a challenge when they vacated. So
And that's part of the reason why we like working with these smaller tenants. They're usually much more decisive. They can move in quickly. The TIs and the leasing commissions are usually a little bit lighter. And we're usually working with the decision maker in the business. So if they're happy or unhappy, we get direct feedback. You know, some of the big tenants that we've lost over the years, we've lost the state of North Carolina at one building, and we've lost Duke. And frankly, we had no feedback or we had no knowledge of that ending. It really, the lease just came to an end after we kept asking for renewal, incentivizing renewal for 2 years prior to that end, and them not giving us any answers. And ultimately, the lease comes to an end, and they just basically disappeared the next day.
Yeah, there's not a lot of
no
back
notice.
and forth. Even our VA clinics, you know, the VA clinics run with an asset manager structure where you don't sign a lease with, you know, a property manager at the VA clinic. You're signing it with an asset manager who manages a pool of VA clinics like any kind of big organization. But they're very responsive, and you get answers from them, and you can work back and forth with them, and they work on different stuff. You might not like the ultimate decision they make on stuff, but they're at least very available. So, which is different. In that large corporate-y kind of lease, you're not getting that.
Right. And so, I mean, since we're talking about the VA clinic, so if you look at the portfolio of assets, we have 21 assets. 11 of them are over 90% occupied. The VA clinics are part of that. Really, all of our buildings that have the VA in them are very well occupied, whether they're single tenant or multi-tenant. Mm-hmm. But one of the challenges we're facing with the VA is that they're really only willing to sign 1 to 3 year renewals. And it's really hampering what we can do with the property. You can't sell a property with really, a 5-year average lease term is kind of the minimum. So we really work up, when we buy a property, it normally has lower lease term. And then over the years, we work on increasing that lease term, especially with the VAs. And as soon as we get that extended renewal, we'll look to sell those assets. But right now, the market is not interested at all in a 1 to 3 year lease.
Correct. Yeah. So we have a lot of VA tenants that are on the shorter time. And our whole business plan, when we go into almost all the asset classes we're in, it's like, how do we take something that's vacant and underperforming with not great leases and build up the wall, build up that weighted average lease term, get it occupied, and then look to what can we do with it? Do we position it to hold, or do we position it to sell? On the VA clinics, the one we mentioned that there's different asset managers. There are some medical deal, we signed a 10-year lease with the VA, and that one we're going to look to take out, and I think we're going to have good market feedback there in 2026 as we look to exit that one. But the other ones, we're only have a 1 or 3 year lease. It makes things very challenging on the lending front, on the exit front. It really doesn't put it there. So those on the VA, we have to keep working with the asset manager, keep proving that we're responsive, can work on the properties for them, and then work to successfully get a long-term lease there. That's our ultimate goal. That creates the most value on those deals.
Yeah, and another successful business story that we've done is really Johnson Square. We bought it barely 70% occupied. There is an autism school at Johnson Square. When we bought it, it was about 15, maybe 17% of the rent roll. And over the time, we've taken that and we've expanded them and worked with them. They've been a great partner with us. And now they're about 30 to 35% of the rent roll, and they're willing to sign contiguous leases that are extended and extended. And we're getting much more average weighted lease term on the property with them as kind of being this anchor tenant. And we're really in perfect position to exit this property either as a refinance or a sale. We took the property out to market last year. We just didn't get really good feedback. We didn't really get pricing. There wasn't very good feedback to it. So going into this year, we got more aggressive on the refinance, and we're in a really great position for a refinance in the high fives with some cash out. And I think Johnson Square is going to end up looking really good in the future.
Yeah, our debt there, because we have good leases in place, we got very attractive debt. For all things considered, high 5% interest rate is a good loan.
Fantastic right now.
Yeah, so right now that's we're very excited about that. That's one of these success stories where it's done really well, and we'll be in a good position. Right. We look at our overall strategy on the commercial side, and again, what falls into our definition of the medical and the government kind of backed leases, and we really went through buying these in a little bit of a spurt. The last deal we've purchased that fits this kind of definition for us was in 2022. At that point in time, we were saying, okay, look, we're going to get as many of these now stable and work to exit them and realize those gains. And so we have 11 that we would consider fully stable and ready to go. We have 4 of these that we are actively listing and trying to work through. We have the station, which we've been going through for a while on the development side, and our plan there, and we will get there on exiting that deal to the developer, which will be a good position. We're working on some of the VA clinics, 1830, 1824, working on Summit and Parsons. So we have a few of these deals that we feel like, hey, now is the time when we're going to push hard in 2026 to move on these.
Absolutely.
So that's really our goal for the year, is we have to realize some of these positions that we're in on the deals and move them out of the portfolio and take those gains, and we'll find other opportunities or just distribute the money back to investors at that point.
And then the remaining of the properties, the other give or take 10 properties that have, say, 20 to 30% of the space, we're going to get more aggressive on leasing terms. We're going to get more aggressive with leaser brokers. A lot of that space that's available is really second floor space. So first floor space leases pretty well. Second floor space is usually a little bit more challenging, especially in medical buildings. And so we're looking at, we're talking about properties like Parsons on the second floor. We have vacant space. Property like West Park on the second floor, vacant space. So we'll have to get more aggressive on the second floor and see who we can basically look at tenants that want to expand is usually where we start, and then who else we can apply incentives to. On
the challenges front, we mentioned shorter term leases, but another part of it is our bank relationships that we have. We had 5 or so properties that were financed with First National Bank out of Pennsylvania. They offered us some of the lowest rates we had ever seen on any commercial deal, which was excellent, between 2.9 and 3.4% interest rates. And most of those loans are coming up in 2026. Now, on that, Summit was one that was supposed to come up this month. We got 6-month extensions on these deals, and they kept the very low interest rate. So we're excited about that. We're going to try and keep those as long as we can, even if we're just cycling or pushing out a 6-month loan. If we keep it at 3.3%, that's excellent for us. So that is a challenge in the fact that we got to keep coming back to this refinance situation. Again, Johnson Square stable, we were getting in the high 5s. These options in the 3s, while that's great, we are going to try and look at like, okay, can we exit these in time before we come up with a new renewal, or we're going to look at refinancing those when we're estimating that stuff to be in the 5s right now is what we're seeing.
And to your point, if we're looking at selling something soon, the cost of a refinance is usually between 3 and 5%. So if we're looking at selling that, we'd rather just stay with the current bank, tell them, hey, working on selling this thing. Can you just give us another 6 months or so while the transaction happens, instead of spending that 3 to 5% on doing the refinance?
Some of the successes that we have had, we've talked about Johnson Square and how well that deal has performed, and the positive news with the bank loan there, but also Midtown. This is a deal. It's been a challenge in itself, but it also has a lot of little wins in between there. We've sold a couple of the buildings there. Our loan, we've paid off almost 50% of the loan through selling some buildings. We have one more building that we signed a lease in the third quarter. We have it fully leased. It's in a good situation. It's our 6,400 building, and we're now taking that one out fully to market, and that'll be our next building that we sell. So overall on this commercial space, we've sold 3 buildings of what we've purchased. They've all come out of that Midtown. Was really the first exit transactions that we saw. We're going to get another one exited there probably in the first 6 months of 2026, which we expect to be very positive for that deal and really significantly pay down the loan that we have there as well. So that'll be in good position. And we really do expect that we're going to push hard on these other 5 deals that we have listed to see some transaction velocity pick up in 2026 and realize some of the positions that we're in.
Yeah, the buildings we bought over the past couple of years, and including the Midtown portfolio, like the Midtown's a great story because we bought the portfolio as 14 properties for $78 a foot, and we're exiting them between $100 and $120 a foot. So it's actually been a tremendous win that we're able to use that money, and we're actually using all the money to pay down the debt to basically improve the balance sheet of the deal. But as we look at the other properties and the rest of the portfolio, our average basis is $140 to $160 a square foot on most of these properties. And we feel really strong that you obviously can't build medical office for anywhere near that. You can't build replacement property anywhere near that. And so we're in a good position long term. It's just getting through this part of the cycle and really operating through this part of the cycle.
Yeah, the deals that we're not looking to sell right now, it's like, yes, we have to be hard on operational efficiency all the time, every single day. It's just making sure that we can operate them as efficient as possible.
Yep.
Okay. So we'll have more updates as we go through the deals that are listed that we do expect to sell in 2026. That'll be kind of the running theme of our updates as we go into the new year. We're excited about the prospects that will happen as we get those sold, and we'll continue to have more updates for y'all. On the residential side in the Southeast market, we're predominantly looking in the city of Atlanta. We have been a net seller of residential assets over the past 5 years, and that trend continued in the fourth quarter of 25 and really for the year of 2025 as a whole. We sold 2 more apartment deals, one apartment, one mobile home park, and it brings our total unit count just to under 1,500 now, probably for the first time in about 10 years that we've been at that low of a unit count. Now, a couple things go into that trend or why we see that happening. The first, our business thesis is really built on the ability to purchase a residential asset and increase the revenue while maintaining operating efficiency. Over the past couple years here, we've seen the flattening of our revenue growth curve from the standpoint that we look at it. In the fourth quarter of 25, our revenue across the board on the residential side grew by 1%. If we look at that on an annual basis, it was about 4% for all of 2025. And we look at that then compared to what market rental rates have done in the assets that we see. We had about a 8 to 9% increase in our marketed rental rates. So while 8 to 9% rental rate increase sounds great, if that trend falls through and comes down to about 1% per quarter, our targets and our growth where we create value needs to be higher than that. When we were looking in the late teens or even the early 20s, we'd see revenue growth that would approach 15, 20% a quarter or 15 or 20% a year. And that's where we're really creating value on the residential side that we could capitalize on. So when we see lower, basically a flattening of the revenue growth curve, that's our standpoint when we look at a deal from our metrics that it's time to exit. We've done all we can on that deal. And quite frankly, a lot of deals right now are penciling to that, and that is why we have been exiting over the past 5 years as a whole. Now, on our operating side, the retention is the biggest metric we track on the residential side. It significantly impacts your expense load. It impacts how you're going to collect rents and what your revenues are going to be. Our target is 70%. And normally throughout the year, we see, if you think about like when are people going to move, fourth quarter is normally the quarter that people move the least in. We've always seen higher retention numbers in the fourth quarter. However, this fourth quarter, we saw 66% retention, which was one of our lower quarters on a fourth quarter comparison side. So that is also coupled with the fact that we're right now sitting in occupancy range that's in the low 90s. We've historically been in the high 90s, so the low 90s, when we're saying, hey, we're going to consistently be at 96, 97, and we see like a 92% number come in, for us, that's a big red flag. It's not 50%, but 92% for us is below where we want to be, even with having a little bit of revenue gains. We saw some assets in the fourth quarter where we dropped into the high 80s and we were able to release and occupy those units. But that means we had a higher expense load in the fourth quarter because of that, and it was also seen because we had a lower retention rate. As we look at going into the first quarter on the residential side, we are just hard focused on operating efficiency and make sure we keep occupancy and we can maintain our revenue. As deals flatline on revenue, that's when we're going to look to exit them.
Some of that flatlining isn't necessarily just the market. I think the headlines have said for the last 2 or 3 years that rent growth has been negative to flat, even in Atlanta, even in Dallas, Texas, where you're seeing tremendous population growth. But some of that flatlining is that we did all the improvements on the property. We made it really nice. We kind of did our full year of, hey, we did leasing specials. Now everyone's in and it's full. And now we're seeing flatlining because we're not seeing the same growth that we had seen. So to Dave's point, they were saying that we like seeing that kind of closer to 20% year-over-year rental growth. And now we're seeing kind of sub 10%. It's not the position that we play in the market. And we're really better off selling that property and letting the next guy take it to the next level.
Yeah, for someone to make that work, they'd have to take one of our deals and go do something drastically different to it. We've basically done all the work we could do on a deal, and that's where it's at. Right. So that moves us into a point on the residential side where we're really focused on operating efficiency. We've had some of these deals, we've owned them 7, 8, 10 years, and we have to really be diligent on how we operate them. It's kind of more experience in the residential side.
You remember I operated from 03 to about 17, so 14 years. And 03 to about 2009, 2010, pretty much my rents were flat. And of course, the rents were really low. They were probably like $650. I don't even think the 600 or 650 rent exists anymore. But so all of my opportunities were about efficiency, making sure we're spending money on the right things, making sure labor is correct. And so, the way I made money for a decade was efficiency and making sure we were spending money in the right places. And if we got a $25 rent increase on an apartment, in those days, that was a victory.
That was big money.
That was big money.
Yeah. So I think part of what we'll see in really 2026 as well. We were discussing the impact of some of these new tax changes on our resident. So no tax on tips, no tax on overtime. So we should see some really nice incentives kind of come back when people file their tax returns, and maybe we'll see higher retention. Maybe we'll see an opportunity to kind of go from that low 90s to upper 90s as people get their refunds back.
Yeah, a big thing we would always track too is like, why do people move? Like, what are they looking for? Is it they're always moving because of a job? For a while in time, it was we would have a multi-generation family splitting apart and getting 2 apartments instead of 1, and that was a big thing we were tracking. Like, hey, we have family units that are taking more space because they're doing better economically. That was one thing we were always looking at. But yeah, it'll be interesting to see if this is something that then leads to either staying longer or maybe reducing a roommate or one of those kind of situations.
We talk about affordability a lot, and there's a lot of energy locally and federally around making more affordable housing, whether that's, there's kind of different ways to tackle it. You can look at it kind of the financial manufacturing side, meaning how do we give more incentives for people to be in apartments or for people to be lower cost apartments or lower cost housing, or just give incentives to the builders to build more supply. So what we've seen in the apartment world, right, is that there's been a ton of supply, but it's mostly been in the Class A space, and they didn't get any incentives for building it, so rents have not come down in that space. or rents have not come down in the Class C space, but they've come down in the Class A space because of oversupply. But it'll be interesting to see as we go into 26 and 27 when the focus is affordability going in kind of the midterm elections on how local government and federal government's going to tackle
Well,
this.
affordable housing is always one of not my favorite topics, but it's just such a loaded topic because you just don't build affordable housing. If you're building affordable housing, you know what that means? Someone else is paying for it. So there's always some type of subsidy or some type of intervention from some type of municipality or some type of something. But affordable housing is from aged real estate. It's from some type of somebody else helping, such as some type of outside help. Could be tax districts, TADs, whatever. But to me, affordable housing is, we had this conversation before, but it's really about supply and it's about what are you building. So, we're talking a lot about building tiny houses are a big conversation right now. So building small houses. So if you could build a house right now, if it's just a little 600 square foot, 1 bedroom, 1 bath house that 2 people could live in comfortably and has everything they need, it's got indoor plumbing.
It doesn't have standards are going up here.
It's got bare minimum granite countertops, and a nice shower, and you can get this for less than $200,000. I mean, that's affordable housing, but it's different. It's different. It's not the 2,000 square foot house in Tucker or Norcross. It's just different. And so expectations, I think, are going to have to change. And I think there is a big movement for expectations to be changed around what housing looks like. Because if you go to other countries, I mean, housing in other countries is tiny. I think Americans have, we've had a luxury of having really large housing for a very long time, but a lot of other places in the world just don't have that luxury.
That makes sense.
When we look at how our specific deals have performed, we talk about if we see the flattening of the revenue curve. We mentioned we sold 2 deals. They both took us a very long time to sell. They took us most of the year to complete those transactions. So things are not flying off the shelves if we look at how is the transaction getting done. And we look at comps for deals that have occurred, and there's just not a lot of volume out there of transactions that have happened. So while we are or have been net sellers on the residential side, the amount of transactions that can happen at one time, it's not like you can sell everything at one time. It's taking time to get through deals. So we sold 2 in 2025. We have 2 more that are under contract going into 2026, which is notably the Grove that's in our QOZ fund and Westside Townhomes. Those are 2 deals that we have been working on for.
Oh, we listed the Grove in January of last year. Yeah. So we're on our 3rd buyer, and we're hoping this will work out. But and the buyers are, we are getting a little bit, if you look at the kind of the deals as a whole, we are getting impacted that the buyers are coming back to us and saying, hey, I told you $10 million and now I only want to pay $9 million. That's one conversation. But a whole nother conversation is that, hey, I'm fine with the $9 million or $10 million, whatever the number is, but I just can't get the deal done. There's not enough financing. There's not enough equity to raise. It's just the market is hard. So we've seen deals blow up for lots of different reasons. The retrading is common, but also just putting the capital stack together is probably more common than the retrade.
Yeah. Recently, we were looking at selling a chunk of our mobile home parks. That was one of the transactions we were working on. And we started at a $22 million number for a couple of the parks. And then after some back and forth, that got retraded down to $20 million. And we're like, okay, this is fine. We're set. We're going to do this. This number still works. We can still transact at this amount. And then after another week, they're like, okay, now we're at 17. And it's like,
this is a whole different deal.
Yeah. $5 million in retrades or 25, 30%. It's like, that doesn't work. Yeah. So that's one of those things where we spent a month and a half in this process and then it kind of blows up on that part. And when we were under contract, we made it all the way through the due diligence part. Was really the end of that like the double retrade. And that's a lot of what we're seeing in the transaction side. It used to be that there was, hey, this is your deal price, and there was not retrading and just being like, I just changing my mind on stuff. It's like, no, the contracts were pretty firm. Now they're pretty loose on whether you have to follow the terms of those contracts or not.
Yeah, so we're gonna continue to work on the deals that didn't sell last year, look to sell those this year, but also throw probably 2 or 3 more into the pipeline of, can we try to sell these? We don't expect any of those to go incredibly smoothly, and really it's going to take the better part of the year to see which actually going to close or not.
Yeah, and we have very specific updates in each deal on like where that timeline is. But yeah, we have a bunch right now that we're in the works on moving right now. Notably, the Grove and our QOZ fund and Westside Townhomes. But then we're also looking at Fairway, which is also in the QOZ fund, and Eastside Crossing, which is another in-town Atlanta deal. So these are deals that, again, if we get to a point where we don't see continual revenue growth, we really see that as we have two options. We can either exit the deal, be like, hey, we've done what we can, or we can find a way to reposition. We could do a big capital investment. We could go get different leverage and take it out and reinvest in the deal. But the returns have to be there to warrant making that kind of next round of capital improvement.
And frankly, that's a good point, because we're really there with our Alpharetta asset, right?
Yep.
We've owned this deal for about 7 or 8 years, and we've kind of gone through the whole cycle of that the low income tax credits have burned off, and now we can take the rents from, they were restricted to give or take $1,000, and then we can take them to market, which market is probably more like $1,400-$1,500, but that's not free, right? We have to go into every unit and take the unit up to market, because this building was built in 1997. And everything's really original from 1997. Yeah. So we're looking at unit by unit to see, okay, if we invest $20,000 a unit, can we take the rents up to $1,400-$1,500? If we can do that, we'll go unit by unit, do the whole property. If that doesn't work, and maybe there's not traction, or maybe the rents are only $1,200 on the market, it will probably get a lot softer in turning the units over.
And in our model, it relates to a lot like your experience in it. We're looking at that like, we're not just going and saying, hey, we're just doing everything, kick everyone out, raise all the rents one time. We're not doing that. We're going unit by unit and saying, what is the best use of capital in this specific unit? Is it okay, we're going to re-rent it as is? Or are we going to do a big upgrade on this one unit, and what do we think we can get? And really tracking, the very specific details on a unit by unit basis of how those investment dollars are being utilized and what return they're generating. But on that deal, we're excited about that. We have an opportunity to go create value and make that work. So we're optimistic there, and that's why we're holding that one instead of selling that one. On the residential front as a whole, we'll keep everyone updated on the sale progress as we have on each specific deal. And if it sounds like we're being redundant, we're like, hey, didn't we already talk about selling that one before? It's like, yes, they're taking a while to actually get through that process. And anytime we do a sale, we always offer a 1031 option. Mostly all of our options have been out of residential into another asset type. That's been predominantly what we have been doing. So we'll keep you updated on sales. Thank you very much for watching all of our updates. If you made it to the end of the video, we really appreciate your time. It's been quite a journey going through all these different asset classes, and we are excited about the prospects of 2026. We're going to be able to sell quite a few deals and really see how that process goes. If you see any of our invites for webinars, we are doing live Q&A sessions on a deal-by-deal basis, especially when there's a refinance or a capital event or a listing coming up on all of our deals. So keep an eye out for those. That's another engaging way where you can meet with other investors that are also in the deal, and we'll go through the specific details of how each one is performing. And lastly, if you can make it to one of our goal days, we do that right at the end of a quarter each time. We have a couple different speakers that come in each time. Next quarter, we have Brian Panosian coming and speaking with us. This quarter, we had Rich Ashton, who flew up from Texas and talked to our whole team, and it was a great presentation. If you can make one of those, that is a great way to meet some other investors that are here, that are local to the Atlanta area, and our team as well. Okay. Thank you very much, everyone.